Alrighty, what's up, everybody? Welcome back to the channel. If you're listening to the podcast version of this, I would highly suggest heading on over to the YouTube channel and checking it out. Our guest today is going to be going over some slides, and I don't know about you guys, but visually, when I see things, they always make a lot more sense to me. If you're driving, though, just listen to the podcast. You'll be good. Watch the video later. But I'm really excited. I got a fantastic guest today. First things first, though, you guys, if you listen to my content, you know I teach and preach being open-minded. One of my mentors, Nelson Nash, used to always say, be aware of the arrival syndrome, basically meaning like, hey, I know everything. I don't need to learn anything else. I'm good to go. When that happens, we stop growing in every aspect of our lives. So today I'm going to introduce you to something that I knew absolutely nothing about, but I was blessed to be at a really awesome, essentially money event, and got to hear this gentleman speak from stage and kind of share what he's been doing. He's actually been in the industry for 20 years. He is the number one, I don't want to say like producer or salesperson, whatever, just the number one educator of Heckams in the entire country. So he's helping people do something that has so much stigmatism around it, but is actually an incredible vehicle that has the ability to change people's lives, much like the life insurance does, much like whole life. People, there's a huge stigma around whole life, but once you understand how to use the product and actually understand the details and everything behind the scenes, it becomes just another tool, another vehicle to help you get to where you're wanting to go. So George is a fantastic guy. I've chatted with him multiple times. I've heard him present this information elsewhere, and I'm telling you guys, whether this is for you right now or not, tune in, pay close attention, because he's going to share something that has the ability to change either your life, your parents' life, maybe your grandparents' life, depending on how old you are. But I'm really excited for him to share this with you guys. So buckle up and let me introduce you to my good man, George Verban here. How you doing, brother?
Shawn, thank you, buddy. Appreciate you, man.
Yeah, excited to have you. Excited to hear you talk about this stuff. The introduction that Cheryl gave when you guys got on stage at the event that we're dealing with, you guys are about to talk about the one product out there that might be more misunderstood, disliked, whatever you want to call it, than whole life insurance was definitely caught my attention, because we get a lot of that in the industry. I'm going to get a little bit of your background real quick. I want to get a little bit of Movement Mortgage's background, and then we'll kind of jump into the juicy details, and we can kind of discuss why there are so many myths and bad talk around reverse mortgages and this whole space in general. So why don't you go ahead and tell the people a little bit about yourself, and then we'll jump into a little bit about how you teamed up with Movement Mortgage and what you guys are doing.
Well, thank you, sir. Again, I've been doing I've been in this space for about 20 years, and I live in beautiful, sunny St. Augustine, Florida, the oldest city in the country. It's not Pensacola, Shawn. It's actually St. Augustine. But I live here in Florida, and I basically, came over to Movement Mortgage. They started back in 2008. The actual CEO is Casey Crawford. Has a giving heart. 49% of the profits actually go to building charter schools for kids in impoverished areas throughout the United States, in particular South Carolina and North Carolina and Georgia now coming up. So we've been doing a lot giving back to the community with our company. We're on all 50 states. But I primarily am called a retirement mortgage specialist, right? So it's in regards to the home equity conversion mortgage, the product that I actually work with. So, but the company Movement Mortgage, I came on board because of their giving philanthropy and what they do, and I love the concept, how they give back to the community. So we're pretty heavily involved in that particular piece. So
awesome. So again, I came into this knowing very little about reverse mortgages. We were talking before we hit the record button a little bit about HELOCs and first lien, second lien, that type of stuff. Can you kind of explain to the viewers what the difference is specifically with a reverse mortgage and something like a HELOC?
Yeah, so the home equity conversion mortgage is a product that has been around actually for a while, but I would call it like the new and improved version today. In the last 10 years, they've done nothing but make it better every single year. I'm sure a lot of people, the stigma that people hear, it's probably stuff that happened 15, 20 years ago primarily. It's not the case today. It's literally taught as a retirement tool today more than anything. But the difference is a HECM is nothing more than a home equity line. That's all it is. And again, just to kind of reiterate, this is a program designed for people 62 and older. It's kind of for that particular category of clients. And it's nothing more than a home equity line. So can people make payments on a reverse mortgage, as an example? And the answer is yeah, they can make payments still. But it's an optional payment program for people 62 and older. They can make a payment while they're in the house. They can wait to pay back the loan when they sell the house, or when they pass away, they can be settled up in that particular situation, pay back the loan. Because this program doesn't require a payment, the interest just accrues over time. It just gets paid back at a later date. But you get to decide when to pay it back, unless you pass away. And then your estate can settle the estate at that particular point. So because there's no urgency, because there's no prepayment penalties, you can pay it back anytime you want. Right. So the difference on a home equity line at a bank are fantastic, especially for people in the younger generation. But as you get into the older generation, in retirement, the goal is cash flow, right?
Definitely.
So you have a standard home equity line. There are three downsides for clients in that category between 62 and 100. One is they have a monthly payment. So they're back to square one where cash flow is still an issue. Number two, the downside is you also have a balloon payment on a home equity line, which is due in 10 years or could be 15. It just depends on the bank you're dealing with. And then the third downside is when the market starts changing and the values start going down in the market, what do they do to your line of credit? Exactly. They freeze it, they reduce it. Well, guess what? When do you need it the most? When the market's
at that moment.
Exactly. So who controls that? The banks, right? The banks control that. The difference with our particular program, which I'm going to go into that next, the clients get to control this line of credit, not the bank. So this is what's interesting. It's pretty fascinating that this particular product has a lot more flexibility than a standard HELOC at a local bank. So again, it's not downplaying the HELOC at a bank. It's appropriate for a lot of people at the certain age brackets. But as far as when you get into this category, there's a big difference, and it definitely favors the heck at this particular age bracket.
A lot of the things that you said kind of remind me again of whole life insurance, kind of remind me of infinite banking and that access, that being in control, that not need for a payment, a lot of similar things there, which I think aligns a lot with what I believe and I teach. So we kind of discussed a little bit about who this is for and who it's not for age-wise. So it's for people that are 62 and older. It's not for people that are under 62. But give me a little bit more specifics about maybe like the ideal client. I know we're going to jump into some scenarios and stuff, but explain a little bit more about people who might be a good fit for this versus maybe not a good fit that are 62 plus.
Well, I mean, the only con or the negative I see in this program currently is people that are looking into possibly getting into it, but they know they're going to move within a year or two.
Okay.
Right? If you're planning on moving, people didn't know this, but you can buy a house with a reverse mortgage. So if you think you're going to move in a year, it doesn't make sense to do a refinance and to do a HECM because of the costs associated with the loan, which I'm going to cover the costs here in a minute. So let me back up because I can't teach strategies until people understand how the product works. So here's the part that people don't know. So how does it really work? And let me go back actually to my earlier comment about the HECM itself. The biggest misconception people have out there today is they think when the last person passes away that the government or the bank takes the house. And I'm like,
Yes.
that's not true. The family gets to decide what to do with the house. So if the family wants to keep the house, they decide if they want to keep it or sell it. It's still a family decision. It's not the bank or the government. The bank only loans the money. The government insures the loan. It's an FHA loan. So they have these protections in place to make sure people don't get taken advantage of. And you only have to follow three rules: pay your property taxes, homeowners insurance, and upkeep of the house. That's it. Well, guess what? That's the same on any mortgage, not just a reverse mortgage. So it's the same criteria, but nobody can mess with you. It's your house. You're on title. The family decides what to do with the house. You can make a payment, not make a payment, no prepayment penalties. So it's a lot better than what people think. It's just that nobody investigates it. They just hear stories from other people. And that's that's the first misconception I wanted to cover right off the bat. So
Gotcha.
how does it really work, right? What they do is they take the age of the youngest of the two people in that age bracket, and they give them a percentage of the value of the house.
Okay.
So just quick numbers, right? I don't know if you can show my slide,
Yeah.
because I want to just give people a little better understanding that in our lives, before I go into how do the percentages work and all that, in our lives, we literally have three different buckets in our lifetime. And people love to use buckets, so we use buckets as well. But bucket number one is earning potential, right? So people are doing everything they can to earn income between the ages of 18. This is an outdated slide, in my opinion. People are still working into their 70s. So let's just say 18 to 70 something years old, and they're trying to do everything they can to set aside money into bucket number two, right? Which is their investment, 401ks, IRAs, life insurance, right? Annuities. And they set aside about 5 to 20% of that money into bucket number two. But then people take 25 to 40% of their income and they dump it in the bucket number three, which is their house. Now they have to, because they need a place to live. They need a roof over their head, right? So this is standard. This is what we've been brought up on. But what's interesting is we have, if you put money into bucket number two, it's actually liquid. What does liquid mean? It means you have the ability to pull the money out, like life insurance, right? You have the ability to pull that money out. But when people put money into bucket number three, where they put a big chunk of their money, is it liquid anymore?
Nope.
Nope, it's not, right? It turns into home equity. So what's interesting is people in the financial planning space, who I primarily work with, financial planners, they've already done all the research. They've done a number. I'm a math guy too, so I always show the math behind this whole thing. But they said, wait a minute, George, so you're saying that if we stop putting money into bucket number three and we put more money into bucket number two, what happens in number two? What happens in bucket number two if we do that? It increases, right?
Yep.
It grows, right? It's going to keep increasing or improving. So all we're doing is redirecting your cash. But unfortunately, we've been brought up, and I'm talking about I'm in that generation, fixed rate loan, pay off the loan, mortgage burning party, give the house to the kids.
Yep.
Right. That's what we've been brought up on. Here's the one dynamic that's changed that people don't talk about. People are living longer. What is the number one fear in America today? It's outliving their money.
Yeah, running out of money.
Yep. So we have to be creative to figure out, how do we protect bucket number two, which I think is the most important bucket. It's not the house. You know, I've been doing this 20 years. Guess how many kids really want their parents' house?
Probably very few.
Very few. Absolutely. Now, there's ways I come up with strategies that the kids do want the house. I have strategies. I work with life insurance agents, and how do we come up with a plan to keep the house in the family? Because there's some families out there that have a beautiful home, maybe been around for 60, 70 years, and they want to keep it in the family. That makes sense, right? But for the majority of the people, they don't want the house. You know what they want?
They want the money.
They want the money, right? So to me, are there better ways to leave a legacy behind for your children? Because it's not the house. What's the better legacy? In my opinion, that's why I'm your biggest fan, Shawn, because I'm a life insurance believer. I really believe that life insurance is paid tax-free in 30 days. You can't get any better than that. So why don't we take the house out of the equation, and why don't we leave a larger legacy by getting more life insurance on us? And you'd be shocked. I mean, I got people even in the early 60s that still don't have any insurance or need insurance, and they decided to let it go because they think the house is the answer. And it should be the other way around. It should be life insurance should be the answer, not the house. So, you know, this is unfortunately that's why we have to educate people that when we show you the math, you know, you can dump 500 grand into a house on bucket number three, but what happens when the market crashes and you die at the wrong time? You literally lost money in that equation, where a life insurance is guaranteed death benefit that you're going to get, right? So to me, it's just common sense, and also education, probably primarily in this case. So what we're trying to do is show people that when they get into retirement stage, where people get in trouble in this age bracket, is they don't have any earning potential when they retire. So now they're in their post-retirement year. Now they go back to bucket number one, and they live off of Social Security income, pension if they're lucky. And then they start spending down bucket number two when emergencies start happening. And the way the stigma happened, Shawn, is people would spend down bucket number 2 when they'd run out of money. They sit there and go, uh-oh, okay, now let's look at bucket number 3 because we just ran out of cash.
Yeah.
They look at it as a last resort or a desperation play. So that's what we're trying to show people is, wait a minute, don't wait till you run out of cash before you do this concept. If we do it earlier in the game and we stop you from putting money into bucket 3, or you pull money out of bucket 3, what does it do to bucket number 2? We're going to push that out as far as possible into retirement, because the goal is to figure out, how do we make your money last longer? So we want to incorporate housing wealth as part of that retirement strategy. Most people ignore it. It looks good on paper at the end, but I don't know of any tombstones out there that says I died with the most home equity. So,
a bunch of equity.
right? I mean, you can't take the door off your house and go buy groceries with it. So
yeah.
The goal in retirement is cash flow. You're shifting gears, right? You're turning everything around now to where you got to figure out creative ways to make it happen and cover inflation and all the things that happen, especially healthcare. I've seen healthcare destroy a lot of portfolios in this case, but people just don't educate people the correct way how to use this product the right way, right? So that's why the buckets, to me, hopefully gives a bigger picture as far as understanding which one is the more important bucket. It's really bucket number 2 that we want, because that's what gets passed on to the kids, right? The legacy is left behind for their children is bucket number 2 that we're showing up on the slide.
Yeah, that makes a lot of sense. And again, we do something very similar with teaching the concept of infinite banking. We actually use 3 cups. They used to use buckets, but having buckets, like I have 3 cups on my desk. I don't want to have 3 buckets on my desk. Same exact concept, though. It just helps visually people see where that money should be flowing to, or actually in this case is flowing with the insurance thing. There's not actually 3 buckets, but it makes the concept that much more understandable. And again, bucket 2 makes a lot of sense, especially now. I don't know, I'm sure you work with some pretty well-off clients, or people that are in, a little bit better than the average situation, but the average person could definitely use more money to help build bucket 2, because they're entering retirement with a couple $100,000 on average in that bucket, which they'll burn through really quickly. And that's why they end up leaving somebody the house or something, because they don't have anything else to leave them. This is all there is. So it makes a lot of sense to be able to get that cash from bucket 3, help defer and build up bucket 2, and then be able to utilize that. That's awesome.
Well, it's actually important what you do, because when you start these people at 30, 40, and 50 and start getting their life insurance planning out of the way, that just makes it that much more easier to make decisions, going forward into retirement. So, leaving behind a legacy is important to a lot of parents that I talk to, and they want to leave something behind for the kids. But we just been brought up, like I said, with the house. But I'm trying to show clients there's other ways, there's better ways. It's not just a house like we've been brought up on. And by the way, Shawn, I don't know if you knew where that came from. Actually, that happened back in the 1950s and 60s, because parents were not living past their 60s. And the kids were in their 20s and 30s. So if the parents said, hey, you want the house? Guess what? They took it.
Yes, I need a house to live in.
Because they didn't live long. Because today, the parents are in their 80s and 90s. So the kids are in their 50s and 60s. They're like, oh, we already got a house. We don't need another one. So this is what I'm saying. There's a big paradigm shift today. And it's interesting you mentioned that I do deal with high-end clients. I help everybody. I help people with very little money to no money. I'm coming up with a strategy today for a client. She's so happy and excited that her roof is leaking. And I'm showing her strategy of, she had no homeowner's insurance. So I showed her with the insurance agents that I helped her out with. I came up with a game plan. We're going to do an escrow situation. We're going to get the insurance. We're going to get the loan, get the money out, replace her roof, and she's going to have peace of mind. Right. So I deal with clients from very little money to my highest net worth is $8 million. I do reverse mortgages because, people go, George, why in the world would somebody with $8 million want to do a reverse mortgage? Well, I don't care how much money people make. Nobody wants to donate to the government. So it's just matter. They're always trying to find exciting, creative ways to how do we keep more money for our family? That's what the bottom line is.
So talk a little bit more about that. How would this be advantageous? Because like you said, nobody wants to give I don't think anybody wants to give anything to the government. We all got to give them a little something. But how is implementing this process able to, like that gentleman, for example, that you were mentioning, maybe it's uh, a woman, I think you said gentleman, that has $8 million. Why? How could this be beneficial for them?
Well, I'm not going to, I'd love to go in greater detail in this call, but the bottom line is when people spend time with me, they're going to get educated first on how the product is used
Hmm.
correctly. In other words, what are the mechanics of the product? Once people understand the mechanics, I literally have different strategies for clients in the country today. I'll give you an example. People with free and clear homes, I do 5 of the most common strategies with financial planners. Here are the
Okay.
5 most common that I do. Number one, people with free and clear homes. I'm talking about they have no mortgage. I'm going to show them how to use this the right way. There's a, I talked about it up on stage, by the way. I talked about the line of credit, how
Yep.
it works, right? So going back to that percentage, if the house is worth 300 grand and I loaned you 100, let's assume there was no mortgage, so they get access to $100,000 because it's based on their age, right? The
Hmm.
other 200 grand is still in the equity of their house. It's still their equity. It's still their house. I just got to only give them a percentage based on their age in this case. Now, there's 3 different ways to get money, but I'm only going to focus on the line of credit today. The line of credit has a fascinating piece. There's 2 buckets associated with the line of credit feature. So let's pretend that house is 300. I loan you 100 in my right hand, but we want to borrow. So if the house is worth 300, for example, and we loaned you 100 grand in my right hand, but we want to borrow, just as an example, 10 grand to replace an AC unit.
Hmm.
That 10 grand goes into my left hand. This is called the borrow bucket because I only borrowed 10. Only the 10 will accrue interest and get paid back at a later date whenever they want to pay it back. But the other 90 grand, what people didn't know is that line of credit sits there, believe it or not, has a growth feature on here. And
Hmm.
they're giving them access to close to guaranteed today, close to 7% a year, just on the growth feature of this line of credit. So that 90 grand next year will go to 96, 97,000 if they don't need the money.
Wow.
Now, what are they really getting? It's really more borrowing power. They're actually getting 7% more of their equity of their house. That's what they're really getting, right?
Okay.
But how does it calculate? Well, at the rate of my left hand, the borrow bucket is 6.5. The unused bucket is growing at 0.5% more, so it's 7 on this side. So it does a fascinating piece. So if the rates drop to 6, this will be 6.5. So it's always going to do this back and forth. So that line of credit continues to grow. It's guaranteed to grow no matter. It's not guaranteed by the rate. The rate's not guaranteed, but the growth is guaranteed. So it
Mm.
doesn't matter. It becomes a hedge against inflation. If the market goes south on the value of the house, the line of credit grows no matter what happens. It doesn't have any bearing at all if the market goes south. So the line of credit keeps growing. But what's fascinating is just like a life insurance policy. When they pull the money out, it's all tax free. Why? Because they're borrowing their own equity. They're borrowing the house value, right? That's what they're borrowing,
Loans
right?
are
Same as the life insurance, right? So now when they pull it out, though, it's considered borrowed. So where does it go into? The borrowed bucket, right? So when you sell the property, do you pay back the bucket that's growing or the bucket that's borrowed?
bucket that's borrowed.
Yeah, it's no different than any other mortgage. So they only pay back what they use. Everything else goes back to the family. It's no different than any other mortgage. So
Mm.
that's a fascinating piece on the line of credit. So now with that understanding, when I teach people how to use the line of credit the right way, here are the 5 of the most common things I do for clients with free and clear homes. Number one, it's called sequence of returns risk. When the market is down, the mistake most people make is they pull out the worst time right when the market's down. They get taxed, and then the market just, because of the market, they just took a massive hit on the probability of the money lasting longer in retirement.
Yep.
But this is considered, like Dr. Wade Fowle says, he is a retired professor for the American College. He calls it a buffer asset. Can we do a standby line of credit where we can pull funds out of this tax-free bucket here? No different than the life insurance concept, right? We can borrow from life insurance too. So we got 2 buckets now, life insurance and this bucket. And can we pull money out of this bucket and let the market recover so we don't take a hit in our portfolio? So we're just trying to protect the nest egg. Again, the ultimate goal is working right alongside the individual along with their financial planner if they have one and help them protect their nest egg. So we want to pull from this bucket. And now that market's recovering and now their portfolio is going to recover and they're going to be okay because they didn't pull money out. Well, I'll stop right there. Do you want to make a comment on that part?
Yeah, I was just going to say that's a great way to discuss it, because oftentimes a lot of people don't view life insurance as the vehicle that's going to just be their one and only vehicle in retirement, but it's definitely kind of that stopgap, and that, that kind of filling in that need, so you don't have to take money out when the market's down and kind of get that double whammy that, just shortens your lifespan of your money
Yeah.
already. So that's a great way to kind of think of it, is that that just kind of fill there for when the market's not doing so great.
Yeah, and that it's going to happen. It's unfortunate, but it's ironic that we need money at the worst time, and that's when the market's down, right? So this is unfortunately what happens to a lot of people because they have no other choice. So the second one I use is long-term care. For a lot of clients out there can't qualify for a long-term care policy or a life insurance policy with an LTC rider. Hopefully they can, and then they can solve that. But when financial planners do an annual review, as an example, they're staring at two people and one of them's unhealthy. There's going to be additional healthcare costs, and guess where they're going to pull it from? They're going to pull it from the portfolio, right? And the problem is if they start pulling money from that bucket, what happened to the retirement plan for the healthy person left behind?
That's
Yep,
different.
just destroyed it, right? So, but we're ignoring a house. But if people understand how the line of credit works, and we can use that as a tool and let it grow, and when its time is right to pull money out tax-free to fund in-home care, why don't we attack this asset first before we start attacking the cash?
Yeah.
Because to me, it's all about protecting, and this is just another tool to help people out, because a lot of people don't have long-term care. 76% of the country is going to need it, but it's shocking how many people have anything in this area because people feel like nothing's going to happen to them. Well, guess what? I had a couple, true story. The guy had cancer, and their portfolio, they had a lot of money though. They had 1.2 million, and they blew it down to about 800 grand, and he died. The wife got diagnosed with cancer, brain cancer. Okay, the odds of both of them getting hit with cancer? Well, the financial planner was trying to get me in there to help them out because they had a free and clear home. So I was trying to show them how to, because they were bleeding through their cash and they were getting taxed. So I was trying to show them how to get in there. But the attorney was stopping me from getting in there because he didn't understand about reverse mortgages. And the attorney was sitting there stalling. Well, months ago by. And finally, we got an appointment with the attorney to come to our office. And between the financial planner and myself, when we got done, not only does she now understand it, she's my biggest fan, and she sends a lot of clients. And we do a lot of Medicaid, elder law attorney planning with this concept now. So we work together trying to show strategies on how to protect the nest egg with this concept, even under Medicaid scenarios. So bottom line is I got in there, did the reverse. Unfortunately, she spent the 800 down to 400. So went from 1.2 down to 4. She needed 24-hour care. She didn't want to go anywhere. She's like, I want to stay here. I'm going to die here in this house. So I want 24-hour care. Well, that was $16,000 a month.
Yep.
Yeah. So she was going through the cash like crazy. So we put the reverse in. Unfortunately, she died like 2 months after I did the reverse. It was already, the damage has already been done. They've spent the money down tremendously. We couldn't put a stopgap basically in that bleeding of the cash and using this concept the right way. So all I'm trying to point out is they thought everything was fine until they got diagnosed with cancer. In this case, both of them did, which is kind of
ironic.
Ironic as far as that part is concerned.
Yeah.
So long-term care is another popular strategy. I'm sure you do stuff with long-term care, right, Shawn?
Yeah, I actually just had spoke with a woman over at One America, who most people believe has the best long-term care product out there because it's based off of the chassis as a whole life insurance policy. So yeah, that's a 35-year-old entry point. So you guys, I think a solution for a lot of these things is make sure you're taking care of things as early as you possibly can,
Yes.
because you don't often get healthier as you age. So
Correct.
put things in place while they're the most affordable that they can be, so you're in the best position to maybe use a HECM later in life and just use it for whatever you want to use it for, not the things that you have to use it for, like long-term care.
Correct. I had a One America representative reach out to me. They want me to speak to the One America people because of how we can work together, with these long-term care strategies in our industries. But yeah, because One America is well known out there on the long-term care side for sure. So
Yeah.
number three, you were asking me, some of the higher off. I work with many advisors, like I said, throughout the country. I do a lot of traditional IRA conversions into Roth, and I show clients how to use tax-free money to pay the tax liability. So there's a lot of different things. I'm not going to, like I said, go great detail. If they get a chance to spend some time with me, I'll show some strategies on that. But I do a lot of conversions from people that have a lot of money sitting in qualified funds. What does that mean? Money that people having in a traditional IRA that's going to get taxed at a later date, right? So
Mhm.
this is a qualified fund. So these are things that we come up with to figure out, again, how do we use this tool the right way to protect the nest egg? How do we keep more of the nest egg for our family, right? So that's all I'm trying to do, show these strategies. Number four, I've actually paid off 2 margin accounts. I've actually had people borrow off their portfolio and get killed on the payments that they had to pay back that was bleeding through their asset like crazy. So I've actually used the reverse to pay off the margin accounts in this case. And the fifth and final one that I do is funding life insurance premiums. There's nothing against us funding life insurance premiums to leave a larger legacy for the families out there. It's their money. They can do whatever they want with that money. I just don't tell people what to do with their money. In other
Yeah.
words, I'm not a financial planner. I'm just freeing up. This is a tool to free up more cash flow to be able to plug in these holes in retirement that people have. So I just kind of give some guidance in that particular piece, but I definitely don't give advice as far as where to put the money. Now, if it was my father-in-law, hopefully he doesn't hear me on this podcast, but he's using his line of credit. He goes to Las Vegas 4 times a year. So he's pulling money out, he makes money, he pays it down, he pulls the money back out. But guess what? He's 82. He's enjoying his life. He's got no payments. He's living the dream. For him, he's happy as you can shake a stick at. So
Yep, if that's what you wanna do. Again, like you said, it's your money, you do what you want with it. Um, as far as the life insurance thing goes, I do think that's a great addition to this because, again, you wanna be able to spend your money, but you also wanna be able to leave money, and the best way to leave a larger sum of money than you actually have is to take pennies and buy dollars with them, and that's what insurance is doing. So, you, by all means, you should have the right, you should, get to enjoy yourself and spend that money that you helped grow and earn throughout your life. But if you still want to do something for the kids, for the family, for the spouse, whoever it may be, make sure you're getting that life insurance so that's able to kind of already have that vehicle taken care of and say, hey, you know what? I can spend down my assets because I have this vehicle that'll make sure it gets paid out to the family. And like you said, they probably don't want the house. They're probably not going to move into the house. Nobody really does that anymore, but they'll definitely appreciate the cash.
I'm actually doing that strategy right now. I turned 62 about 4 months ago, and I did my reverse immediately. And I freed up my cash and I put more money back into my life insurance premiums. So I'm a big believer. I'm actually walking the talk. I mean, I really believe that's the best way to leave a larger legacy. So my kids don't want my house. So I already got a plan for the kids are going to be fine. I'm definitely worth more dead than alive, though, Shawn. That's for sure. So
Same here. That's not a bad thing. Not a
yeah,
bad thing. You've done some right things in your life, and hopefully, as you keep increasing that actual income value that you're making, that death benefit keeps increasing along with you. So it's a win-win on both scenarios.
yeah, yeah. So yeah, so that's that piece. Another misconception people have is understanding about inheritance.
Mm.
Can the kids inherit the house? The answer is yes. It's no different than any other mortgage. They just have to pay back what was borrowed. Um, but if they don't want the house, they got to let the key to this whole thing is communication with the kids too when they pass away. Um, they have to notify the bank in 30 days what they want to do with the house. They don't have to solve the problem. They just got to notify them. Just say, hey, you want to keep it or sell it? And if they want to sell it, they have up to 6 months to settle the estate automatically. And you can get literally 2, 3 month extensions if you have to, up to a year to sell the property and pay back the loan. And then whatever money's left, the family keeps.
Okay. So what if they walk me through the other scenario? If they want to keep it, kind of what might that look like? Are they able to, I don't know, assume that mortgage and start taking on
No,
payment?
so no, so what they're going to do is once they let them know that they want to, they'll give them a time frame to
Okay.
either refinance, pay cash. That's why the life insurance is so critical, because if they got life insurance on them, they're going to get that tax free paid in 30 days.
Hmm.
So once they get the payoff, they just write the check and pay off the loan if they want to keep the house. But here's what the kids have been doing: they cash in the life insurance policy, they keep the money, and they sell the house.
Yeah.
So, but they gave the kids the option to decide what to do with that life insurance. But they got a good 3 months at least minimum to refinance or pay cash to figure out how to keep the house if they really want it.
Gotcha.
You can,
Yeah.
again, you can
That's
get an extension, yeah, too.
options is what you're looking for there.
Right.
Uh,
Okay.
so what do you feel like people are, there's a lot of myths, misconceptions out there. What do you feel like people are missing most about this? Because it seems like this is a newer style of the reverse mortgage. Much like a lot of things out there, just general whole life was this thing that's been around for 200 plus years. And then the concept of infinite banking came around, and people realized, oh, this is a way that I can actually utilize this vehicle, this product, uh, and get a whole lot more value out of it now. Uh, what do you feel like the big difference is between what people might actually think the reverse mortgage is, or what it kind of was before,
Yeah,
and what this is now? Because this sounds like a pretty sweet deal.
it is. And there's, again, we're stuck with the desperation or last resort. That's unfortunate, but that's a stigma. It's interesting you compared it. Your analogy is exactly what the reverse industry's gone through, where you got a whole life policy, and then you get to later stages of the years to where people start figuring out the infinite banking concept. So you're finding how to fine tune that tool, and that's exactly what we're doing in the reverse space, or at least several of us in this industry, where we're teaching them more as a retirement strategy, and more of a retirement tool, not a necessarily a desperate. Can we help people that are in need? Absolutely. But what's it mostly being used for? Once people figure this out, they're using it now to leverage. No different than a life insurance policy. They're figuring it out. It's
Mhm.
like infinite banking concept on the reverse mortgage side. It's really what it boils down to, right? So we're in the same boat. There is one more misconception, that people have. Like, for example, um, one of the negatives that people always bring up is closing costs. Closing costs are a little bit more on the reverse because it's not a conventional loan, it's an FHA loan.
Okay.
So 2% of the 4% of these costs go straight to the government because they're insuring the loan. So this is the way I explain it: is if if we go back to that original scenario, and I'm going to give you a hypothetical worst case scenario. If the house is worth 300 grand and they borrowed 100 and never paid it back, but
Okay.
the interest on the loan grew over 20 years, and they owe 300,000 20 years later.
Okay.
Okay, I'm giving you a crazy worst case scenario.
Mhm.
But they died at the worst time. The market crashed. House is worth 200. It's upside down 100. Who writes the check to the bank for that upside down 100? Is it the kids? Do they go after the assets?
Nope. Not the family, not the kids.
Do
It's
they go after the kids?
government. I guess it's the
Yeah. Yeah, good job, Shawn. So the answer to that question is neither one, right? Because this is a non-recourse loan, which means whoever's left behind is not on the hook for anything upside down. But the best part about it is it can't touch the assets. So who
mm,
actually writes the check to the bank? It's actually FHA.
mhm.
That's why the closing costs are more on these programs, because that 2% is cost is an insurance policy. Speaking of insurance, it's an
Yeah,
insurance policy for the parents that if they do this strategy, it's peace of mind knowing they're not passing debt to their kids.
that's awesome. I think that's a big, probably overlooked factor that people
It is
see a bit more expense up front, but you're getting that security and that peace of mind on the
correct.
in knowing that I'm not going to be screwing my family here if I do.
Exactly. And that's the fear that people have out there because they think that they're going to put the kids on the hook, but nobody explains this. That's what I'm trying to, this is what I deal with all the time. It's like, no, that's not true. This is what happens in these scenarios, but you're protected. Here's what people didn't know too. The kids still have first rights. If it's in an upside down scenario, they get to buy the house back at 95% of the value, not what's owed.
Okay. Wow.
Yeah. Now there's more to it. We can only cover so much in the next, a couple minutes, but I do a lot more. I do literally a portfolio review. I look at their finances and I try to figure out for clients, how do we plug this in the right way? How do we make your money go further? How do we solve that and take the pressure off you and give you peace of mind at night that you've got another bucket to pull from and you're going to be okay. Everything's going to be fine. So, like I said, I've been doing it 20 years. My clients still call me 20 years later. Strategies change. I just had one in Orlando that had a loan with me, and they had it for 3 years. And the wife called me out of the blue and said, "Hey, George, I need another strategy." I said, "What happened?" "Well, John died, and I don't want to stay here anymore. I want to move closer to my granddaughter." And she goes, "What's my next strategy?" So she's funny. She remembered the word strategies because I was teaching her strategies. And I said, "Well, let's go ahead and sell the house. We're going to show you how to pay back the reverse mortgage." Here's what I did. I took a part of her money she got from the sale of her home. I showed her how to put that as a down payment on the new house down the street from her daughter. And we financed the difference with a reverse mortgage that doesn't require a payment. So I showed her how to buy more of a house with less cash and no mortgage payments for the rest of her life. And she's right down the street from her daughter. And then I took the rest of the money and I put it back in her retirement account. I replenished her housing, her physical portfolio, because I'm taking some of that housing wealth to put her in a better position financially to go there into this new house with no payments, but also help her with padding her account, basically. Because remember, when somebody dies, you lose a Social Security check.
Yes.
And the 2 Social Security checks go down to 1. So what we're doing is we're now, that fact that she doesn't have a payment is crucial now, because she only has 1 Social Security check coming into the house.
Yeah, the government's so nice to let you keep the bigger of the 2 checks. Just, so nice of them. Yeah, that is tough. That whatever income was there is essentially, I'm not going to say it's split in half because we don't know whose Social Security check was bigger, but it's essentially split in half, give or take.
Yeah.
So that's awesome. That sounds like a solid strategy, and it's great that, again, when you preach those things to people that you're working with, and you put in and you implement things like the strategy that you did the first time around that I'm sure was working for them. When we serve our clients to the best of our abilities, they're always going to come back if things change. At least you hope that's the relationship that you build with them, that they know, I can go back to George. I had this huge, massive change in my life. My husband passed away. This is what I want. This guy took care of me first time around. I'm going to go back to him. I'm sure she talked to some of her friends in the area and told them what you were able to help them with first time around. That's everything we do. That's what it's all about, is like, hey, if we can help you to the best of our ability, we know you'll spread the good word. We know you'll help educate your friends. We'll know you'll help send them back to the source, which is where they're really going to get educated and get all of their questions answered for their specific situations.
Yeah. And, you have a younger generation, right, Shawn? So you work with the people between the 30 and the 50 something range.
Yep.
Just food for thought for that audience. If you have a parent right now that's in a 2-story house and they're in their 70s and 80s, and they're by themselves, or they're married and both of them are still alive, while they're healthy, I want to show you how they can, I don't call it downsizing, I call it right sizing. It's learning how to right size, get a house that's less expenses, less maintenance, easy to get around. Because trust me, they're going to get to that point. And it's going to be these 2-story houses that they're sitting in. A younger family can appreciate it. So that's why let's go ahead and switch gears and start figuring out where's that forever house going to be and get them in the right house. So if you know anybody parent-wise that needs help, I'm happy to guide them through. But I got to educate. I got to spend time with them and teach them and show them what it's not, as well as what it is.
definitely. Well, George, let people know where they can find you, how they can contact you if they feel like they got any value from this, or they want their parents or grandparents to have a chat with you. What's the best way to get a hold of you?
Yeah, so I'm at Movement Mortgage. So I don't know if you can see my name on the screen, but basically it's George dot. There's a dot between the verb George and verb at movement.com. It's very simple at movement.com. And by the way, my company, we have retired mortgage specialists throughout the country. I cover 25 states in particular, but you have to be licensed in that state. So if we don't have anybody licensed in a state, I'll guide you to retirement mortgage specialist that is in that particular state that does similar strategies that I do. And Movement Mortgage, we just got rated one of the best customer satisfaction for reverse mortgages in the country. So happy to help out and study your situation and figure out how we can come up with some solutions and help you out. So yeah.
That's awesome. Well, again, really appreciate you coming on. I'll end it with this, guys, for sure. If any of this seemed valuable, or you just want to have a conversation, definitely reach out to George. And the last thing I'll say, I leave it with this all the time, you guys. The information is free, but the knowledge is priceless. Go have a conversation with him, have him talk through your personal situation, and find out if this is a good fit. Because if it is, and you don't ever go and find out about it, you'll regret it later, like with most things in life. So, George,
and if they can't get a hold of me, obviously just reach out to Shawn, and he'll guide. I'm sure you'll guide him right back to us. So.
Yep, definitely. I'll put his information in the description below in this video, so you guys can go find it there. But yeah, man, thank you so much. Really appreciate it.
Awesome, man. Appreciate you. Thank you.
I definitely enjoyed it. All right, brother. Have a good one. I'll connect with you soon.